Good. It is officially afternoon. Good afternoon, everybody. Thanks for joining us today for this call. My name is Adam Durgis. I'm one of the founding partners of a company called Raintree Financial, and I'm thrilled today to have with us Greg Bainbridge, who leads a division of our company called Raintree Wealth Management. Really excited to hear from Greg today and what he's got to say and how things have been going with RWM. Greg, thanks for doing this.
Thanks for having me, Adam, and hello to everybody on the call.
Yeah, let's get right into it. This is an area of our company that we're really proud of, and nobody here at Raintree is under the impression that we're right and somebody else is wrong or anything like that. The world is too gray for anybody to draw lines in the sand about being right or wrong. But we are very, very committed to our values and very committed to our philosophies. And one of those philosophies is about being flexible. And so it's a kind of a funny thing to be committed to being flexible, but we are. What I would challenge you to do today when you're learning about this is not to grade these philosophies in terms of right or wrong, but simply to look at them and ask yourself how they align with your philosophies, right? We don't want to work with anybody who we shouldn't work with. And so it's not about being right or wrong. It's about finding the right fit for the right client and the right people. So that's something that I would challenge everybody on to take that approach. They're learning about this today. But Greg, without further ado, I'm going to turn it over to you. I'm going to turn my camera off just to save a little bit of bandwidth. And when you get your presentation going, you can feel free to do the same. And then we'll turn it back on when we get time for Q&A. Oh, and on that note, for those listening to the call, if you have questions, I would ask that you use the Q&A box at the bottom, not the chat box, only because it's a lot easier for me to keep them organized if we do it that way. And what I'll do is if you ask a question that I feel needs to be addressed right away, I'll interrupt Greg and get him to answer it on the spot. And if not, we'll save it till the end of the call for the Q&A section. So with that said, over to you, Greg.
Awesome. Thanks, Adam. And again, welcome everybody. I'm just going to pull up all of my pages here. Wonderful. So hopefully everybody can see my screen now. I've got a number of slides, and I think we've got an hour and a half booked for this call. I won't drone on for that entire time and would really love to keep this more conversational and interactive. So as Adam mentioned, please feel free to jump in with questions as we go. And Adam, I'm going to ask you to jump in because I know you're obviously very familiar with our service and how it resonates with clients. If you think I should be spending more time on something or less on another, feel free as well. Here's a quick agenda of what I was hoping to cover today. I'll spend more on certain areas than others, but really, and Adam already mentioned this, we want to work with people who our philosophy resonates with their own. And so today's agenda is really more about education than anything else. I will at the end there spend a little bit of time on our view in the markets today and how that interacts with our portfolios and our philosophy in general, but really try to think of today more as education than anything. The way I'll start is with who we are. And so this is an important one because some of our clients who have worked with more traditional advisors in the past, where it's very transactional, and by that I mean they may sit down with their advisor and say we should buy some Apple stock, or we should sell some of our TELUS shares, or maybe let's invest 60-40 into a portfolio, and then once a year we'll readjust that as we need. Our service is far more of a fully managed service and far more dynamic than transactional recommendations like that. And so what we do with our clients is at the outset of an engagement, we sit down, we learn about what your goals, your objectives, your risk tolerance, all of those sorts of points. And what we do is we come up with your investment policy statement. And that investment policy statement really sets the guidelines and the playbook for how we manage your portfolio. And once we have that set, what we do then is we manage your portfolio on a discretionary basis. So if we see an opportunity in the markets to invest in something that fits within the guidelines of your investment policy statement, then we go ahead and do that, as opposed to phoning you up and really getting your pre-trade approval to make that trade. And the benefit of that is it allows us to be very quick to respond to changing markets, and it allows us to be really dynamic in how we move our portfolios. And as you'll see in a few slides here, I'll give you an example of sort of how the benefit of that we saw saw in March of 2020 when markets were going crazy as people were sort of realizing the impact of COVID. And so I'll try and provide some more anecdotal evidence of that as well. In terms of our team there, you can see our smiling faces, both from our investment committee and our client service and operations team. The one point I'll make here is that is an important one, and the theme that you're going to hear through this presentation is really around governance. And what we've tried to impart on our platform is oversight and governance in how we make investment decisions. We think that one of the greatest challenges to being an investor, and that can be all the way from the chief investment officer of the Canadian pension plan, all the way down to the individual who's got a self-directed TFSA, and that is the behavioral bias and the emotions that get involved when we're investing. And so we've really tried to structure our team, our process, so that we're cognizant of those and really test them. And what I mean by that is our investment committee, as a collective group, we make decisions for our clients, and as opposed to an individual on a one-off basis. And that forces us to debate the merits of each trade. It forces us as an investment committee to sometimes to dispute certain sides of the opinion, which is healthy dispute. But ultimately, what we come to is a decision that is grounded in data and objective reasoning, as opposed to our own emotional biases. So we also like to talk about our core beliefs, and this really goes back to really finding that philosophical fit. And so the first there is that we have the conviction to be different. And what we're trying to say there is that we don't want to always follow the herd of investing. We think a lot of the times managers in Canada, the US, and the world really are trying to follow the index very closely, don't really create a different outcome for clients. And we really are cognizant of that and also want to create a better outcome for clients. And to do that, we need to look different and hold different portfolios at certain times in the cycle. There's probably no better example of that than today's market. As you'll see that we're relatively defensive in today's market, and you'll pop open a headline just about anywhere you look now to see everybody very bullish on the market. And we'll obviously highlight why we're in a more defensive mode in today's world, but that really speaks to the conviction that we have in order to look different at certain points in the market cycle. The second there is we invest globally and we use specialists. So we're not only looking at Canada, we're not only looking at the US. We think some of the best opportunities right now actually are in international markets and emerging markets. And to access those markets, because we don't have the expertise of the 25 best stocks in emerging markets right now, we use specialists, institutional asset managers, to help us build our portfolios and help us select those names that we should be holding. And I'll talk a lot more about our sub-advisors as we go. And then lastly is value. We're value-based investors, which really means that we use value to assess where the risks and opportunities are. And what that means is we want to own more of assets or investments that are cheap and less of assets that are expensive. And you might ask, well, how do you determine what's cheap and expensive? Really, it's the price that you're paying for that asset relative to the expected income that you're going to get from that asset. And if you think of this in the context of a stock, how much is my dividend, or how much is the growth of that dividend going to be relative to the price I have to pay for that stock? Again, something that I'll highlight in some more detail with some more visualizations as we go here. So quickly, in terms of how we build and construct portfolios themselves, I've sort of touched on this, and this is the idea of being dynamic, right? These are the bands that we would set with a client. This isn't any actuals. This is really just meant to highlight the dynamic nature of our portfolios, but you can see that the different bands that we could be invested there in equities, fixed income, and then the last category there is more diversifying, meaning something other than your traditional equities and fixed income. And what we do is we move our investments within those bands. And so what we saw in March of 2020 was obviously a very quickly changing investment environment. We came into March in a defensive position. We weathered the downturn in March very well. Our growth fund, for example, was down about 8.5% relative to the Canadian equity market down over 30%. And we, during the month of March, actually made a number of reinvestments to increase our risk in our funds. And so we were able to move 10% of our holdings, for example, back into equity investments, all within the course of an afternoon. For a more traditional transactional model, that's nearly impossible to do, because you'd have to call each of your clients, you'd have to book meetings, get approvals, and that, of course, could take weeks. Because that we have this more dynamic structure, and because we use a pooled approach that I'll highlight in a second here, we're able to really quickly respond to those changing markets. And I mentioned a pooled approach. What do I mean by that? So really, there's two different ways to own investments. One is you can hold the individual investments, think of stocks, directly in your account. So you open up your TFSA account and you'll see Apple, TELUS, Bell. The other way is to use a pooled approach. And what pools do is they would combine all of the different investments for all of our clients into a fund. As you can see, we use two funds, our preservation fund and our growth fund. And then our clients own the funds themselves. And so if we ever need to make or want to make a change to our asset allocation, we can do so just within our two funds as opposed to all of our client accounts. That makes it very efficient to make asset allocation changes. It also reduces costs from a trading perspective. And it allows us to take advantage of quickly moving markets like we saw in March. One other quick point here, and I may jump back to the slide at some point in the future here, but as you can see, our equity allocation in the growth fund is quite low. It's only 50% of our growth fund. The reason for that, again, is our defensive positioning today. And we're overweight, we're holding more of our diversifying strategies. And so that's something I want you to just keep in mind, hold in mind as we go through the slides here, because again, I think it's a unique way that we are implementing our views on markets today. So for each of these categories you see here, in this case here, it's Canadian equities, Canadian stocks, emerging markets, emerging stocks. I mentioned that we use sub-advisors to help us build those portfolios. This is a look at the sub-advisors we use today. The best way to think of this is our investment committee is saying, for example, we want to hold 10% of our portfolios in Canadian stocks. What we're then saying is, okay, in this case, Butel Goodman, please build us a portfolio that you think contains the best stocks in Canada. And what Butel then does is go out and build that portfolio of the individual names. So we're selecting how much we want to invest in a market, and our sub-advisors are selecting how much they want to hold of each individual investment itself. I'm going to run through each of the four sub-advisors here to give you a sense of who they are, their track record, their pedigree, and what part of the portfolio they manage for us. The first here is Butel Goodman. They are one of Canada's largest independent asset managers. They have over $40 billion of assets under management today, 32 investment professionals, and a minimum investment of $1 million. Now, that does not pertain to our clients. That is for clients going direct to Butel Goodman. And what you'll find is very similar stats for the rest of our sub-advisors. Really, our value comes in being able to aggregate these sub-advisors together so that we appear as one client to each of these managers and therefore get access to their talent and expertise. Butel Goodman manages our Canadian stocks there. You can see their long track record. They began in 1967. Obviously, a very long track record, and you can see their outperformance relative to the benchmark there as well. Our second here is Foyston, Gordon and Payne, a very similar type of story and a very similar type of style to Butel Goodman. The method or the style or strategy that both Butel Goodman and Foyston use is really that more traditional stock picking approach. So they go out there and for each of their markets, they'll say, what are the best 25, 20, 30, and usually ranges somewhere in and around there, stocks that we want to hold, and they will pick those stocks. And that to us is obviously a very important component of our portfolios, really represents the more sort of fundamental core of our portfolios, but it's certainly not the only investment style or strategy out there. And so what we do is we complement both Butel and Foyston with our next two managers. The first here is ETF Capital, and they're more focused on tactical return. And what we mean by that is really more opportunistic. So they're more quick to change the portfolio based on what they see in the, say, 1 to 3 month time horizon. That's valuable to us because our investment committee is really spending most of our time thinking about the long-term outlook of our portfolios. And so by using a tactical manager, we can still take advantage of the risk management characteristics of using more of a tactical approach. And you can see how well how well ETF, I should say, has done on a defensive positioning. Back in March, ETF was our best performing fund as we saw markets sell off because they've got a real eye on risk management. And then our final sub-advisor is Polar. Polar Asset Management is who we use for those diversifying strategies. And so the unique part about Polar is that they are not reliant on markets trending in one direction or going up. And the way that they earn a return is very different than just a buy and hold investment. What they do is they look for pricing mismatches or pricing differentials in markets. And what they'll do is they'll take both sides of the trade on that and wait for the price the price differential to collapse and then move on to the next trade. So an example of that, because that's somewhat technical, a really good example of that would be their long short fund that you see here. And so what they do with the long short fund is they pick the stocks that they think are going to do the best, and they would buy those stocks. And then they would pick the stocks that they think are going to do the worst, and they would short those stocks. And when you short a stock, when the stock goes down, you actually earn a return. And so if they're buying and shorting with relatively equal amounts of the portfolio, any broad move in the market essentially cancels itself out. If we see another March 2020 time horizon or time frame and markets are just collapsing across the board, well, their fund here is going to be relatively neutral because their short positions will be doing very well, but their long positions won't. And the same is true on the other side. If markets are broadly moving up in unison, well, their long positions, the stocks they bought, are doing very well, but their short positions aren't. So their ability to earn a return comes from finding the ones that will do well versus the ones that won't. And you can see their track record speaks to how successful they've been in doing that. That's a very impressive long-term return profile. The more impressive part in our minds is really the fact that this fund in particular has not posted a calendar year with a loss since it began in 1997. And that includes going through timeframes like the dot-com bubble, 08, 09, 2016, all these different sort of bear markets that we've seen since the late 90s. They've been still able to post a positive return. And really that to us speaks to the risk management component and the purpose of why we use strategies like this that I'll highlight in a few more slides for you. Adam, are there any questions in the queue so far that I can help address or answer?
There's a really good question, but we are going to save it for the Q&A section.
Okay, that sounds good. Just to quickly finish off on our sub-advisors, the other important part of this to note is that the 4 managers that I just walked through, we have complete control over using. So we can allocate as much or as little as we like to each. And we can also fire, add, change any of our sub-advisors as we see fit. We're not locked into any contracts with them. And importantly, we don't have any ownership in them, and they don't have any ownership in us. And so that frees us from a conflict that may be present in terms of using one, even though we may not think that their strategy, their performance has been doing well. And so we're not conflicted in making those investment decisions when it comes to our sub-advisors. In fact, since we began in 2017, we've already made a change to one of our sub-advisors. So Butel Goodman and Company, we brought on about a year and a half ago now, and we replaced our previous Canadian investment manager with them. And the reason we had done that was not necessarily performance related. It was because we saw a massive turnover in their senior management team. And that just didn't leave us with the comfort and confidence of the firm philosophy continuing, which is why we ultimately made the change. And so I think that also highlights the fact that we are closely watching, monitoring, and keeping an eye on all of our sub-advisors. We're in constant contact with them. We're picking their brains on what they see in the market and feeding that into the decisions that we make as an investment committee.
Greg, can you just push in on that a little bit? Describe the process of what ultimately, I mean, you gave your kind of reason that you had a little bit of a, I don't want to call it a red flag, but, reason to push in a little bit. It's easy to make a change after there's a problem. This was a very proactive change. And as you said, it wasn't done before there was any upheaval to their performance or anything like that. So just talk about that. Was it a decision for the investment committee? How did you react? How did you go through that? Just dig in a little bit on that part, please.
Sure. Yeah, absolutely. So it is something that is inherent to our process. And I think that's probably the first point and the first way that it gets caught by our firm. So every investment committee that we have, and as an investment committee, we meet at least quarterly. We've actually changed that now to monthly. So we're meeting on a monthly basis, but we're also meeting on a more ad hoc basis if we see something going on in the market. So in March, we met 5 times, for example. But as part of our investment committee agenda, we review all of our sub-advisors. And so once we were alerted to the change that we saw going on within the manager, it was really a debate amongst the investment committee of what impact could this risk have? How probable is the risk occurring? And ultimately, we felt that from both lenses, it warranted a change and a search. And part of the benefit of including this in our process is that we can catch things earlier. And we actually underwent about a 9-month search to replace them. So it wasn't a fire sale. We have to get rid of these people right now or anything like that. We had a very methodology, whatever that word is. We had a very structured way of analyzing and finding a replacement for them. And so we didn't want to be put under the gun to do something very quickly. And instead we wanted to do something that was far more structured. So I'd say it's inherent and baked into our DNA and baked into our process itself. Does that answer your question, Adam?
It did, yeah. I think the word you were trying to use was methodical.
Methodical. Thank you.
Yeah, got it. Yeah, no, that was great. And further to that, how many other companies like this do you guys have your eye on at any given time in terms of adding them to what you're doing, replacing one of the existing managers? Talk about that. Like, do you have a pipeline of other groups that you'd be looking to work with if the need presented itself?
100%. We have, I couldn't even give you the number right now. But we have our tentacles all over the street, right? Adrian, so we're headquartered in Edmonton, but as you see, Adrian here is based in our Toronto office. And so he's got very close links to all of the major shops and keeps, his ear to the ground on any new and emerging strategies as well. So I'd say the new managers that we're actually evaluating on a proactive basis right now would be somewhere between 3 and 5. And the ones that we've looked at, decided to pass on, would be in the 25 plus range.
Got it. Okay, perfect. Thank you.
Yeah. Awesome. So I'm gonna jump into some of our pricing, performance, and more of the service itself to give you a sense of a better sense of some of the other features as well here. So from a pricing perspective, we took a very deliberate approach here. And what we wanted to do was remove the black box feeling when it comes to pricing and fees. And so the matrix that you see here can seem complex. We did so because we wanted to really pull back the veil and make sure our clients understood what they were paying for what. And so to read this chart is these are annual percentages. The investment that you see down here is the aggregate investment per household. So that would include all accounts per household. And once for any client that is within that range, the entire account is priced at the rate. It's not the case of on the first 500,000 you pay X and then on the next you pay Y and you have to come up with this blended rate. It is an all-inclusive fee. And I'll work off the top line here for our clients between 100 and 500,000. So you can see our management fee here is 1.7% per year. That includes any annual account fees. So there's no $150 RSP or TFSA administration fee. That is all embedded in this. There are no deferred sales charges. There's no upfront commissions. Really, it is an all-inclusive fee. We wanted to, though, break that out so clients really understood the value they were receiving as part of that. And so the advice component you see here, that is really for the planning piece. The advice that our private wealth advisors bring to the table, which is such a huge and important component to the overall financial plan strategy for every client that they work with. And so that's really what's represented by this column here. So that might include financial planning, advice, estate planning, whatever it might be, insurance planning, whatever that might be would be included in that advice component. Raintree Wealth Management is really us as your portfolio manager. And so that includes everything from asset allocation, sub-advisor selection, trading, everything is really included in that piece. And then we also wanted to highlight any embedded costs. So these are fees that you wouldn't see on your statement. They are fees that it would be embedded in the fund itself, really to run our funds. That would include things like our sub-advisors. That would include things like trading, custody fees, administration, everything sort of contained within that figure. And that's where you get to the total column per year that you see here. So again, we've broken it out this way really in the interest of transparency to really highlight the value that comes from the different points in the relationship. Next slide here is our performance. And this is our performance back to November 30, 2017. And there's a couple of sort of points on this itself. So we've got two different tables. The first here is our growth fund and our preservation fund returns. So this is quarter to date, and these go up to January. Year to date is the same because we're right at the start of the year, and then 1 year and inception. And you can see that our performance has been very strong more recently. Inception, we're slightly under the benchmark, and that's really because of our risk profile. And we've taken a very defensive stance here in our portfolios. And so this return structure is something that we've anticipated. Because return is only one component of the picture. You have to look at that from also the perspective of how much risk you've taken to achieve it. And that's really the purpose of what this Sharpe ratio down here calculates. And so what that's saying is, how much return did I realize for each unit of risk that I took? And so the higher the number, the more return you realized per adjusted risk. And you can see on a 1 year and inception basis, our funds have been above what the benchmark has once you normalize for that risk. To give you a better sense of the risk profile, this looks at it from two different perspectives. One is maximum drawdown. And so what that means is, what was the maximum loss we saw in the portfolio from the peak to the trough? Not surprisingly, this has occurred in March of 2020, both for our funds as well as for the benchmarks. And then volatility shows you how much the return is varied or oscillated over time. And from both perspectives, you can see that we're taking about half the risk in our funds as the benchmark. And that is, again, by design right now. We are set up to hold a more defensive portfolio because we believe we are approaching the top of a market cycle. And when we get into the market update, I'll go into further detail on that. But this is a feature of our funds in that we change risk on a dynamic basis, meaning we're defensive today, but we're certainly not going to be defensive always. And when we see markets get back to levels that appear more attractive on a long-term basis, we're going to be increasing the risk in our funds to take advantage of that. Before I dive into the market update slides here, just a little more on the nuts and bolts in terms of the safeguarding of your accounts and your assets. We use a top 6 Canadian bank to custody and safeguard our clients' assets. So all of our clients, we coordinate and we set up accounts on their behalf with National Bank Independent Network, and that is who holds the cash and the capital. We're provided with the ability to trade those accounts for our clients, but we do not have access to the cash itself. We can only direct and advise on how it's invested. We use a third-party fund administrator that calculates all of our pricing in our funds. That is a third-party independent company. They calculate our pricing every day. And then all of our funds are audited as well on an annual basis by PwC. In terms of our web portal, we've got an online portal. Clients can go in to see their holdings. It's updated daily. They can drill down by portfolio, account, transactions. Also contains all their statements on there as well. And speaking of statements, we send formal quarterly reports. You can see an example here. It provides a very concise breakdown of what's gone on in the account. What contributions did I make, withdrawals, what was the change in market value, all of those things are easily highlighted for our clients to see. And then the last point I wanted to make was just on communication. And so one of the things that we want to be leaders in is keeping our clients informed. And what an example of this would be when things went sideways in the market and in life in March of 2020. Markets were selling off very quickly. There was a tremendous amount of uncertainty across the world. And what we did is we recorded brief 5-minute videos for all of our clients to digest every week. So every Friday, we sent our clients a quick video to keep them informed of what was happening in their portfolios. And those would include things like, how were our funds performing? What risks did we see on the horizon? What were our exposures to certain assets? So for example, oil went negative at one point early last year. And so we talked about our exposure to the oil sector, which was ultimately extremely low. But these were touch points that we wanted to use to keep all of our clients in the loop and feeling more confident and comfortable. I'm happy to say that as a result, we didn't actually receive one inbound call throughout the entire sort of COVID initial period, because I think we were keeping people proactively well informed. And so that's something that we continue to do anytime that something dramatic is going on in the market. For example, the election last year, we sent a pre-election update on how we were positioning the portfolios as a result of that event. So one more thing I think that we think is very important for our clients. Okay, so I'm going to quick time check. I think we're doing okay here. I'm going to spend just a couple of slides here on the markets today and really give everybody a sense of why we are in a defensive mode today and what we see on the horizon. So without further ado, let's just quickly dive in. From an economic perspective, it is still looking like there's a long way to the recovery. Obviously, we're extremely hopeful of vaccine news and vaccine progress, but from an employment perspective, we still see quite a large gap to where we were coming into 2020. This is the US employment. And you can see the dramatic drop here initially through April, and then the recovery. The one thing that we're very cognizant of is how the recovery has slowed. And in fact, in December in the US, it turned negative again. In Canada, it's a very similar scenario and situation. We saw a really large drop and then this gradual recovery throughout the year. But again, we saw in January another negative sort of downturn in those numbers. So something that we're very cognizant of in terms of what that economic recovery itself looks like. Now, when we think of the economy and how that's translated into the financial markets, this is one look at the impact of that. So this is the S&P 500, the most sort of widely followed index in the US. And what we're showing here is in the gold is the price of the S&P, and in the gray is the earnings of the businesses in the S&P. And we've normalized it so they both start at the end of 2019 at 100. But you can see how earnings have dropped and the price has increased. And so this gap is obviously what we spend time thinking about and are concerned about. So what it's saying is you now have to pay a higher price for less earnings from those businesses that you're investing in. It's the same story in Canada. You can see that the market's recovered very well, but we've seen this declining earnings for all of the businesses within the TSX as well. And so this difference, this gap here really comes back to the idea of valuation. And as I was mentioning, what's cheap and what's expensive? Well, when you have to start paying more for something that's giving you less earnings, that means it's becoming more expensive. If these were flipped, we'd be really excited. We're seeing a higher earnings per share in the businesses. We're going to be getting more dividends, more income from the investments we're making at lower prices. That seems like a phenomenal idea. And that's really the situation that we want to be big investors. In this market, though, what it's saying is that you have to pay more to receive less income in the future. And so this is obviously 1 year. This is a snapshot of 1 year in the TSX or the S&P 500 that we saw earlier. What we can also do is look at this on a very long time horizon. And this data is for the S&P 500. It goes back to 1880. So it gives us a very good sense of the long-term change in valuation. And this is not a stock index. This is not the price of the stock market. It is how expensive the stock market is. And what it's doing is comparing the price that you have to pay to invest in the market relative to how much earnings you saw for the average earnings you saw for the last 10 years. And so by taking the average last 10, we can smooth out any bumps in the business cycle and get a better sort of long-term view and vision. The way to interpret it is that when it's high, that means you're paying relatively more for the investment relative to the earnings, and therefore we'd say it's more expensive. When it's cheap, it means the price is lower relative to the earnings you're getting. And so what we've done is we've actually dissected this into 3 different regimes, if you will. In the red here that we're calling expensive, these are times when the market is obviously more than 2 standard deviations away from its average. That's just stat speak for it's high on a relative basis. And you can see there, the Great Depression in 1929 was one example of this. The dot-com bubble in 1999 was another. And then very recently, 08, 09 is the other sort of peak there. And then you can see where we're at today. So we've gone now beyond the Great Depression and we're quickly approaching the dot-com bubble. But what we're interested in is if we started investing at one of these points in time in the expensive markets, what would our return have been for the next 10 years? And on average, that number comes out to a little less than 2.5%. On the flip side, if we were investing in one of these cheap times or in the cheap markets, our average return for the next 10 years comes out to over 11% per year. That is a huge difference in terms of future expected returns. And that is one of the primary reasons why we're very interested in investing more capital, putting more risk on the table when we see cheaper markets. This is the US. Other markets globally have different levels of cheap relative to expensive. In our minds, though, the US makes up such a large component of the global equity markets that on a portfolio basis, we're underweight because of that fact. And so the one thing I'll point out here, though, is that this is descriptive of the risk in today's market. It is not predictive of what the return to the market's going to be a year from now, right? In the case of the 2000 dot-com bubble, you had multiple years of being in an expensive market before the bubble crashed in early 2000, 2001. So what we are looking to do instead is if we want to remove risk from the table, where do we go? We can't just put the cash under the cushions and call it a day. That's not going to be beneficial. Inflation could potentially eat away at our returns or at our purchasing power there. And that's really where we use our more unique strategies and styles like polar asset management, where they are not exposed to the same amount of market risk, and we can still continue to earn a return while we wait for markets to come back to levels that we find more appealing. Again, more anecdotal evidence of that is in March of last year, both of our investments in Polar Asset Management at the worst sort of point were down about 2 to 3%. And again, contrast that to the equity markets that were down 30%. We think that is obviously very beneficial from a risk management perspective. And both of those funds finished the year in double digits, and one of them was actually over 20% return for 2020. So that's really the style, the philosophy that we approach our funds and our portfolios by. Is we want to be very cognizant of where we are in the broad market cycle and use unique strategies that'll help us manage risk and also return. Any questions you think we should address there, Adam?
No, but I think what you just said is a really important part of this presentation, right? I mean, we talked earlier about the philosophy and is this the right fit for the people on this call? And that's ultimately what we're here to figure out. You know, we're not suggesting that risk is bad. We're not suggesting that you shouldn't take risk in other places in your life. We're not even suggesting that maybe a higher risk portfolio isn't the right thing for you. But what we've found in the way that we've been constructing portfolios with people is when we take a defensive approach like this to the core of someone's portfolio with preserving that in mind, it allows people to take other risk in their life with a clearer head, right? You're not risking your core, or you're not adding a whole bunch of extra risk to that rock that you're going to build your retirement plans on. But every cake needs a combination of cake and icing, right? You can't make a cake out of nothing but icing. And so when we're looking to add risk with people, typically it's on top of a portfolio like this. It's not in place of, it's not driven by something hyper risky. We add it to something when we've got stability in that core of your portfolio. Is that what you're typically finding, Greg, with the clients who are really gravitating towards this strategy? Is that kind of the philosophy that they're taking?
Yeah, absolutely. I mean, we are often a component of the overall portfolio, and how we fit into that overall portfolio is ultimately what's most important. And we can also change the amount of risk within our funds now. So for clients looking or that can afford taking a higher risk, we can also go further out on our risk spectrum itself, and vice versa. We can always increase capital preservation measures as well. But I think you're exactly right that we are a component, and in many cases we're used as the balancing component in clients' portfolios.
Yeah, exactly. Thank you.
So I'm going to jump ahead here, and that's what I wanted to walk through today. In terms of next steps, I'd encourage you to speak with your private wealth advisor, and they'll be able to walk you through in terms of how to learn more about our business, our platform, and we'd be happy to set up further calls where you can, again, ask questions on a one-on-one basis too. So Adam, I'll leave it there, and I'll open it up for any other questions or any other comments that may be.
Yeah, that's perfect. So thanks for that, Greg. So the first question that came in, and this is what I've been sitting on, do you have an ethical investment portfolio? If so, can you talk about that? Or is this something that you're planning for? Just talk on that topic, please.
Sure. Yeah, no, it's a really great question, one we get often for sure. So when it comes to ethical investment portfolios, it is certainly a sea of gray as opposed to black and white, I'll say. And that comes from a few different perspectives. One is we see styles and strategies out there that will use an ESG, environmental social governance approach on an omission basis, meaning they won't hold any of those funds that rank poorly on those measures. They'll look at it on an inclusion only basis. And then there's some strategies out there that are simply marketing ploys. In fact, I opened an ETF the other day called it was the Climate Vegan ETF, and held no investments in there that would seem whatsoever related to that strategy. It was Microsoft, Google, and Alphabet, pretty much. So we're very cognizant of what's available. So I guess to answer the question is, we do not have a specific ethical portfolio. We do analyze and work with our managers and our sub-advisors to understand how they implement that in their portfolios and their selections. For example, our emerging markets manager very recently talked about how they were increasing the level of diligence they were doing on those factors, and also talked about the need to sharpen the pencil on it, because a lot of the times the screening criteria may be misplaced or may have omitted those investments that actually do rank very highly on an ESG factor inadvertently. So we're really working to understand how our sub-advisors are implementing that into their selection, but I can't tell you that we've got a very specific ethical portfolio today.
Greg, this year in particular, and I think it's in part due to the fact that there's a lot of people that are bored and are investing in the stock market. It seems like a lot of these things we've been reading about, it's almost like a replacement for going to the casino and playing slot machines, right? There's some really interesting things that have been happening. The term hedge fund was used a lot, not very long ago, in all this stuff around GameStop and AMC and Robinhood and all the things that happened there. Talk about the difference between the way that Polar does things and the way that, a lot of the hedge funds that were really coming under fire, sort of this David versus Goliath scenario. Talk about that. Is that the kind of thing that Polar would have been caught up in or related to in any way?
Yeah, good question. So the hedge fund world itself is, again, very broad. And there's so many different sub-strategies to each hedge fund that they're looking at. A lot of those that were picked on, I'll say, during the GameStop saga had very focused, and I don't want to say concentrated because I haven't seen their entire portfolio, but from a sort of public facing perspective, they were vocal in what they were doing and what they were going after. And that is certainly not Polar's strategy. So in a lot of the cases, hedge funds will hold extremely concentrated positions in, say, 5 to 10 names that they think are going to do well or not. And really they do that because they think that will enhance returns. And by holding that concentrated portfolio, Polar takes a far more diversified approach. In particular, their long short fund, where they would be shorting equity names, they're holding in excess, I want to say, of 50 different stocks just on that side of the book. Not only that, but it's also diversified from a sector perspective. They've got limits on the weights that they can place in any stock, and it's usually extremely low, less than 2% is typically where those weights will come in at. And in fact, during that time, Polar was also proactive in making sure that they understood their exposure to where an attack, if I can call it an attack, from the retail crowd might come from, and adjusted their book as a result. So out of all the hedge funds that we've talked to, that we've reviewed, Polar has an incredible focus on risk management. And it really sort of seems embedded in their culture, which is part of the reason why we think they've been so successful and been able to outsurvive really any other hedge fund in Canada.
Yeah, and that itself is actually going to dovetail into my next question. Why is it that it's hard to find a hedge fund that's been around for quite a while, right? Like, one of the most unusual things about Polar, like if you want to get really simple, one of the most unusual things about Polar is how long they've been in business in this current fashion. Yep. Why don't hedge funds last very long typically?
I think there's a few reasons for that. I mean, one is hedge funds are a newer investment structure than your more traditional investments. Beyond that, though, we also see a survivorship bias happening in that part of the market. So what I mean by that is, a lot of time, if hedge funds have a high risk appetite and are really trying to shoot the lights out, they may burn out, close down, and start up shop under a new name. And that can potentially happen a number of times. And so what we see there is we see inception dates that are far later than Polar's. Polar's began in 91. And if I recall, not too recently, the next closest was 2001. They actually split apart and were sold for sort of pieces. And so really, most hedge funds that you see today have been born out of 2007, 2008, 2009, or later. And Polar really stands alone in terms of its longevity and track record.
And one of the things that's also unique about hedge funds, and not to make this too much about that, but one of the other things that's unique about them is the way they're compensated, right? Like, they're compensated heavily on their performance. And if a hedge fund gets to the point where they've had some years with some losses, they can either shut things down and start fresh, or work to recover those losses. And then it's only after they do that that they would start to enjoy their performance bonus again. Is that right?
That's right. Yeah, they do have a sizable amount of the fees of their overall fee that would come in the form of performance incentives, and by that they have to earn a return or a profit for clients before they can partake in those performance fees. And they do that with what's called a high watermark. So what they can't do is earn 10% one year, lose 20% the next year, earn 10% the next, and still sort of capitalize on that performance. They have to go back to their original high water point from a return perspective before they can begin participating in that performance fee again.
Right. So yeah, it explains, and I certainly get asked a lot, right? Because there is a lot of negative stigma around the hedge fund world. So it's nice that we've got one that truly is different from most of the rest, which is a nice thing. Because a good hedge fund is a wonderful thing if you can find one, and Polar's track record speaks for itself.
Absolutely, yeah, and we've been in their offices. We've met with management numerous times, and it's a very well-run organization that's got a whole, again, culture and intent built around risk management first and foremost.
Yeah, for sure. Greg, you've done a really nice job explaining to people why you think we need to be defensive. And it proves a lot of things, right? Like it proves that you can't time the market is not something that's perfectly predictable. Just look at the last year, right? There were so many things that happened in the last year that were very counterintuitive and went against some of the numbers and things like that. So like, why do you keep your resolve, and how do you keep your resolve in this philosophy that we're going to buy value? We're going to be disciplined in that regard. We're going to do that. In the last year, people who went exactly the opposite actually had a really good year. It doesn't mean that's going to happen in the future. Just how do you keep your resolve in the face of things like that?
Yeah, well, I mean, that's a big question. And I'll tell you, I guess the first thing I'll say is that it's not easy. And when we began our business, we really wanted to do it with that behavioral and emotional bias in mind.
Right.
And the only way to do that is to use a data-driven valuation framework, or else how do you know when or not to make changes to the portfolio, right? And what we see far too often is in moments right now in markets, everybody's watching their neighbor get wealthy off of Bitcoin or Tesla or whatever it is. And that is emotionally really hard to live through, right? And the natural result is then to enter the market themselves. And of course, that's the exact opposite of what we're supposed to be doing, right? Buy low, sell high. The problem is everybody does the exact opposite because of the emotions and behaviors that get involved in the decision-making process. And so when we began, we knew that risk was the number one thing we wanted to manage against. And so to do that, we had to put into place that data-driven framework. And really, we're operating off of probabilities far more than we are in any certainties. And what our model does is it allows us to be more probabilistic in determining what our future 10-year return is going to look like. And unfortunately, nobody really can predict what's going to happen on a 6-month basis. But on a 10-year basis, things start to converge and become far more clear. And that's really what we've really instilled in the process. And so to actually execute on that objective, we've had to stay very true. And a lot of times we have to look back and look at our philosophy statement, because even as an investment committee, we see the same behaviors and biases, right?
Sure.
We see this occurring all the time in the market, where you can look back through history and see this all over the place, where very large US banks, pension funds will be telling you that the bull market is now at the top of 2000, because from a career risk perspective, that's what they need to believe. And so it's extremely difficult to have that discipline in how you're making those investment decisions.
For sure. And it's one of the things that people need to understand. Not every good decision is going to benefit you, and not every bad decision is going to hurt you, right? Getting risk-adjusted returns or targeting strong risk-adjusted returns, it's simply about making sure that the potential reward is equal or better to the risk that you're taking, right? Greg, you and I could play a game where we're going to make bets on coin flips. And for every time you're right, I'm going to pay you 1.5 times your money. And for every time you're wrong, I get to keep it all. right? You're going to win 50% of the time on average. But over time, you're going to lose because I get way more money than you do I get more money for a loss than you do for a win, right? So now you could do that and go, oh, heads, I won this time. I made a good decision. Well, no, you won. Doesn't mean you made a good decision, right? And it's the same thing with the way that we have to look at risk here. It's not about getting everyone right. It's about putting yourself in a position to win more than you lose. And again, there's no right or wrong answers to any of these things, but that is a core philosophy of ours. Are we getting a better return than we should for the risk that we're taking? That's what we're looking at. So you talk about our track record and you compare it to the benchmark, but the risk profile that these portfolios embraced or took on compared to the overall risk profile of those index is notably different, is it not?
It is, yeah. And so we stepped through one of those slides where roughly we're taking about half the risk
Right. Half the
within
risk for
in our
most of the
portfolios.
return. Right. And to me, and you can't really cherry pick just certain little blips in time, but the downside capture that we had or that these portfolios had through those first 30 to 45 days of COVID, there's a big outperformance there. Right now, you can't go back and just cherry pick little times like that, but it did sort of show that the downside capture is a lot less than you would get if you were in that index fund. So take that for what it's worth. So with that said, I don't think there's any more questions left. Greg, do you have any kind of closing comments before we let everybody out?
No, I don't. I just want to thank everybody for spending the time today, and we've been more than happy to set up further dialogue for anybody who's interested.
Yeah, for sure. Anybody who is interested in learning more about this, I mean, everything you do at Raintree it's a customized, bespoke overall portfolio, and this may or may not be a part of that for you. So by all means, talk to your advisor, and if there's any follow-up questions or meetings, we're always happy to do that. Greg, great job as usual. Thanks for doing this, and everybody else who chose to invest a little bit of your time with us. Thanks for doing that. We're grateful you did. Thanks, and have a great day.
Thanks, Adam.
Take care.